Warren Buffett and Charlie Munger, Why We Don't Invest in Nike Stock. Introduction. Warren Buffett, one of the world's most successful investors, is known for his disciplined approach to value investing. His company, Berkshire Hathaway, carefully selects businesses based on strong fundamentals, long-term potential, and fair valuations. Despite Nike's position as a global leader in athletic footwear and apparel, Buffett and his team have notably avoided investing in the company's stock. But why? Welcome back to the channel, where we simplify personal finance so you can take control of your money and achieve financial freedom. Today, we'll explore the key reasons why Warren Buffett has steered clear of Nike stock and what investors can learn from his rationale. 1. Valuation concerns. Buffett is known for his focus on buying undervalued stocks with strong fundamentals. Nike, as one of the most recognized brands in the world, often trades at a premium valuation. Its price-to-earnings (PE) ratio tends to be significantly higher than companies that Buffett typically invests in, making it a less attractive option for his value-oriented approach. Nike's strong brand and dominance in the sportswear industry command a premium, but Buffett prefers companies that offer greater margin of safety with their stock prices. Overpaying for a great business can still lead to poor investment results, which is why Buffett waits for opportunities when stocks are trading below their intrinsic value. 2. Overvaluation and the price factor. Charlie Munger, like Buffett, follows the principles of value investing, which focus on acquiring businesses at prices below their intrinsic value. Nike, as a highly successful and widely recognized brand, often trades at a premium valuation. Its price-to-earnings (PE) ratio is typically high, which contradicts Munger's philosophy of paying a reasonable price for great businesses. Nike's brand strength keeps its stock price elevated, making it difficult for long-term investors like Munger to justify purchasing at current levels. He has often warned against chasing growth stocks at unsustainable valuations, and Nike fits this category. Moreover, Munger emphasizes the importance of margin of safety when investing. Overpaying for a company, even a strong one, reduces the likelihood of high future returns. Nike's stock has historically been priced for perfection, leaving little room for investors to benefit from undervaluation. In Munger's view, it's better to wait for a downturn or a mispriced opportunity rather than invest in a company that already has high expectations built into its stock price. 2. Lack of a strong economic moat. While Nike is an industry leader, Munger may argue that its competitive advantage is not as robust as that of other businesses Berkshire invests in. The sportswear industry is highly competitive, with Adidas, Under Armour, Puma, and countless emerging brands continuously fighting for market share. Munger looks for businesses with long-lasting and insurmountable economic moats, such as Coca-Cola's brand loyalty or Apple's ecosystem. Nike's moat, built primarily on marketing and brand perception, is more vulnerable to changing consumer preferences and competitive threats than the moats of other Berkshire holdings. Nike's success largely depends on maintaining its brand power, marketing effectiveness, and continuous innovation. Unlike industries where Buffett has made significant investments, such as insurance or consumer goods, the fashion and apparel industry lacks the same level of consistency and pricing power. Nike's reliance on fashion trends and brand prestige makes its business more susceptible to consumer behavior shifts. While the company has built an iconic brand, Munger prefers businesses with structural advantages that are difficult for competitors to replicate, such as patents, network effects, or cost advantages. The footwear and apparel industry, despite Nike's dominance, remains prone to disruption from emerging brands, direct-to-consumer trends, and changing consumer tastes. 3. Dependence on endorsements and sponsorships. One of Nike's biggest strengths, its athlete endorsements, is also a potential weakness. The company relies heavily on star athletes and celebrity partnerships to drive sales and brand loyalty. While this has worked well historically, it introduces risks. Athletes' reputations can be unpredictable, and controversies surrounding endorsers can damage the brand. Moreover, endorsement deals are expensive and can eat into Nike's profit margins. Buffett typically prefers companies that do not rely on high marketing costs to sustain their competitive advantage, Additionally, marketing-driven businesses often require continuous reinvestment to maintain brand dominance. Nike's massive advertising budget is necessary to sustain its position, which eats into profit margins. This is in contrast to businesses that have inherent demand due to necessity, such as insurance or energy companies, which can generate consistent revenue without the need for aggressive marketing. 4. Low dividend yield and capital allocation. Buffett favors companies that generate strong free cash flow and return value to shareholders through dividends and stock buybacks. While Nike does pay a dividend, its yield is relatively low compared to other investments Berkshire Hathaway typically considers. Nike prioritizes reinvesting profits into marketing, product innovation, and expanding its global footprint. While this growth strategy has been successful, it doesn't align with Buffett's preference for companies that return significant capital to shareholders in the form of higher dividends. Nike's aggressive spending on branding, expansion, and endorsements means less capital is available for dividends, making it a less attractive option for income-focused investors like Munger. Additionally, companies with lower dividend yields tend to be valued more for their growth potential than their income generation, which does not align with Berkshire's typical investment preferences. Furthermore, Munger prefers companies that excel in capital allocation. Nike's capital expenditures on marketing and athlete endorsements, while necessary for growth, do not fit the profile of the efficient reinvestment that Munger admires. Instead, he looks for businesses that can generate high returns on capital with minimal reinvestment needs. 5. Supply chain and geopolitical risks. Nike's reliance on international supply chains introduces risks that Munger tends to avoid. The company manufactures most of its products in countries that are susceptible to geopolitical instability, trade disputes, and regulatory changes. Munger has always emphasized the importance of operational stability in the businesses Berkshire invests in. Nike's exposure to rising labor costs, potential supply chain disruptions, and ethical concerns regarding labor practices make it a risky choice. The company has also faced scrutiny over labor conditions and factory working environments in some of its supplier facilities. Munger and Buffett have historically preferred companies with fewer regulatory and reputational risks, particularly in areas such as supply chain management. The unpredictability of regulatory changes, tariffs, and geopolitical tensions makes Nike's global operations a potential liability. 6. The fashion industry's cyclical nature. While Nike is a dominant player, the apparel and footwear industry is cyclical and influenced by short-term fashion trends. Munger prefers businesses that are less susceptible to shifting consumer tastes and economic downturns. Nike's performance is tied to consumer spending habits, which can fluctuate with economic cycles. During recessions, discretionary spending on apparel and shoes often declines. Berkshire Hathaway's portfolio leans toward businesses with consistent demand, such as insurance, consumer goods, and utilities. These industries provide more predictable revenue streams compared to companies that rely on discretionary spending. 6. Buffett's and Munger's investment philosophy, the key takeaway. Buffett's avoidance of Nike stock doesn't mean Nike isn't a great company. Rather, it simply doesn't fit within the parameters of his investment philosophy. He looks for businesses with strong economic moats, consistent earnings growth, undervalued stock prices, high returns on equity, reliable cash flow, and dividends. Nike, despite being a dominant brand, operates in a highly competitive industry with high valuation multiples, reliance on marketing, and external risks that Buffett generally avoids. Munger's investment approach is deeply rooted in long-term value creation, and he avoids industries prone to volatility and unpredictability. Nike, despite being a dominant global brand, does not align with Munger's preference for businesses with stable, high-margin operations and predictable revenue streams. The company's reliance on brand perception, marketing spend, and competitive industry dynamics makes it a more uncertain bet for a long-term value investor. Additionally, Munger has frequently emphasized the importance of simplicity in investing. He often avoids businesses with complex risks or unpredictable elements, preferring those with a clear and sustainable path to profitability. Nike's heavy reliance on branding and fashion trends introduces uncertainties that do not fit within Munger's ideal investment profile. Conclusion: while many investors see Nike as an attractive growth stock, Warren Buffett and Munger have stayed away due to concerns about valuation, industry competition, reliance on endorsements, and supply chain risks. For value investors following Buffett's principles, it's a reminder to prioritize fundamentals, long-term consistency, and fair pricing when selecting stocks. Although Nike may not be a Buffett stock, it remains a powerhouse in the sportswear industry. Investors must assess whether it fits their investment strategy, just as Buffett does with every company he evaluates. For investors who follow Munger's philosophy, the takeaway is clear: prioritize businesses with durable competitive advantages, reasonable valuations, and predictable earnings. While Nike may be a great growth stock for some, it simply doesn't fit within Munger's framework of long-term value investing. By studying Munger's rationale, investors can learn the importance of patience, discipline, and sticking to proven investment principles. Whether or not Nike stock performs well in the future, Munger's avoidance of it serves as a reminder to focus on quality investments that align with one's core investment philosophy.